on.
Oh, I always do. Okay, because that's my name. I'm black belt in real estate taxation.
Dang.
I have those things. I have Uncle Sam besides me. Somebody has to punch the guy.
Damn.
There we go. Okay.
That's awesome, man. That's awesome. So, do you know how I first saw you on the internet?
I don't know. You were looking for porno.
I was on the internet, and you had written out a post basically saying that a bunch of people go out and do sub 200 finance, and they get themselves in big trouble because they don't pay the taxes on the income. And I was like, we did a bunch of sub 200 finance. I don't know what he's talking about. I don't know what I have no idea. But I thought you were just a regular real estate investor then. You know what I mean? I thought you were just a guy that invests in real estate and was out there talking on the internet. I had no idea you were a CPA, had any tax background or any of that. So Jacob, my business partner, he obviously does all that. So I go run into him. I'm like, hey, how do we do the taxes on our sub 2? And he's like, we have to carry it all on the front side. And I was like, that don't make any sense. What happens if we have to foreclose? And he's like, I don't know. We'll figure it out when we have to foreclose. Well, look at what's on my list. Sub 200 finance foreclosure. We had our first, I don't know, 3 or 4 this year where we carried a profit on the previous year's tax return because we sold it owner finance, and you make that $30,000 margin, so you got to carry. You made 30 grand even though you didn't realize that gain, and now we've taken them back. So right out the gate, like what does that look like on a tax return? How do you fix that? How do you go back and do something with that?
How do we fix that? Okay. What are we fixing? Okay.
Well, okay. I don't know what we're fixing. I'd tap Jacob in. So whenever we carried a $30,000 profit that we paid taxes on, so we paid $30,000 whenever we sold it the first time, even though we didn't realize the $30,000 gain. We sold it owner finance, we bought it for 70, so we sold it for 100 owner finance. So we're carrying a $30,000 profit that we paid taxes on. Now we had to take it back. Within 18 months to 2 years, we've taken that asset back. So obviously we didn't make our 30 back in that amount of time, but we've already paid taxes on it. We've already, you know what I mean? We've already paid taxes on that $30,000 worth of income. Now we have the asset back that we're going to resell owner finance. And I guess I allege that we'd have to pay taxes on it again when we sold it the second time. So how does that work whenever we're owner financing and paying the taxes on the gain up front?
Okay. So you assaulted me immediately with something which is technical. Okay, which is fine. Okay.
Well, it was my biggest question. It was my biggest question. I should have sent you all my questions because you don't have to explain it to me. You can just say it can be done and then call me and we'll get it figured out and we'll go from there. It was always the one question I had when I would see, I guess you and John, I don't even know John's last name, Heyer or Hyman.
Yeah. Mm-hmm.
Y'all go back and forth on this. Y'all have differing opinions on it. On how to carry the taxes on owner finance. But the IRS code is very clear. Cannot sell inventory on installment.
Okay. Yeah, we don't have different opinions with John, by the way. Cool. John, one of the okay. John is one of the few guys who actually knows his stuff real well. We are friends. So in most situations, we're on the same page.
Okay.
So what you asked about first is, okay, let's roll back to your question. Your question is, what if because we mixed, here is the thing that drives me nuts when we have discussions about tax issues with anybody, okay? So what happens is people take different issues, throw it into the same question, and then get answered. Well, there are different things thrown in because we immediately talked about owner finance and immediately assumed that you would pay 30 grand, the tax on your 30 grand up front. Maybe yes, maybe no. That's a separate issue. Okay. Your issue was, okay, if you did, we already assumed you did. Maybe you don't have to, but if you did. So what we're talking about, you got something for 70 grand, everything in, you bought it with repairs already rolled. You got it for 50, put 20 in repairs, you have 70 in the deal, you are owner financing it for 100, and you decided you pay taxes on 35. That's the assumption. Then you are taking it back, and you are saying is I'm going to pay taxes on that second time. You never pay taxes twice.
Okay.
Let's get that clear. Like, there is never a situation in the tax life when you pay tax 2 times on the same income.
Okay.
Like, people talk about it. Double taxation, blah, blah, blah. Double taxation exists in the concept of C corporation and doesn't exist even there. You know, people write about that. Yeah, it's a different topic. But generally speaking, let's be clear on one thing. You never pay taxes twice on the same income. So what happens when you do that, it's a timing issue. Sometimes you pay taxes early, sometimes you pay taxes later. So let's take 1031 exchange. 1031 exchanges. No, tax is not eliminated. You are pushing tax into the future. Like, you made profit now, you're paying taxes later.
Right.
Owner financing of flips. And when we talk owner financing, we have to draw a line. You already mentioned, yeah, IRS code is very clear. Well, I'm glad you think so. That IRS code is very clear. Okay. You are talking. Your title for the podcast was about talking about bad advice on Facebook, right? Okay.
Yes.
That would be bad advice on Facebook. IRS code is not clear.
Okay.
But the distinction there is when you talk owner financing, I owner financing rentals or I owner financing flips. Big difference. So if you're owner financing rentals, you never have a problem. That's easiest thing, not like as much easy as it is relatively clear. So you owner finance your rental, you get down payment, you pay taxes on part of the down payment. You get your next monthly payment, you pay taxes on part of the monthly payment. So you pay taxes as you receive income. Right. If owner finance flips, and that becomes a pattern. The key word here is pattern. So if what you are doing is you buy house, turn around, immediately sell it. Then, you know, you buy 5 more and do 5 more deals like that. And then 10 more and then 20 more. By the end of the year, you did 50 deals. All of them are buy house, you know, same month immediately sell it, pocket a profit. Okay, those are called inventory. Yes, on those you normally see everything in the tax code. I would put normally. There are exceptions to almost any situation. But so if you do flips, then you deal with that situation when you pay tax upfront. You have not received your 30 grand, but paying taxes. Okay. So what happened if you get it back? Okay, just details there are crazy. But to simplify it as much as possible, as in your example, you sold it for 100, you pay taxes on 30. So you are considered to have sold it for 100. If you got it back, you have 100 in the deal. If you turn around and resell it for 100, there is 0 tax. You know, sell 100 for 100. If you turn around, sell it for 110 on your second round, you have 10,000 in tax. But you never will pay tax again on the 30. Again,
he said when we take it back, that we then have what we sold it for in the deal.
You don't have it, but tax-wise, exactly. You do have it if you pay taxes up front on that already.
See, that's a simple answer. I understood that. I'm a laid off roughneck. I understood exactly what you're saying.
So we're done for today?
No. Not even close. Yeah. So what got me about your post was there's a guy down in Houston, a guru of sorts. He sells $50,000 memberships.
Okay, on Houston, everybody is a guru.
I know. And I trusted this guy, right? So when I see him on Facebook talking, this is what caught me about your post. This is when I was like, I need to jump on a live with this guy. And you had said something along the lines, if I'm working my normal job and I'm making $200,000 a year and this and that, can I buy rentals and carry that depreciation against my income? And you put the answer as no. And I was like, oh shit, there goes half my investment strategy. You know what I mean? Like this is something that I've heard this guy repeat 100 times if I've ever heard him say it one. And I mean, he's put it out there like, you know, hey, you know, if you're working a W-2 job and you're making $200,000 a year, then you can go out and buy rentals in your personal name and then just carry the depreciation against your income. And you're doing more investing there than you would be if you were messing with wholesalers trying to trap equity and all this kind of crap. So I took it as gospel. And that's why I was like, you might have read some of this that I wrote. And so I went and told people that, you know what I mean?
Okay. Yeah.
And I asked you on that post, I was like, that's not the truth. What is the truth? And you said there was limits. And so how does that work? How does that work? Where do you get cut off from being able to write off to carry depreciation against your personal K1?
Okay. Again, like we always do, we are throwing multiple things into one question. Okay, so no problem. Let's try to pull it apart. You know.
Okay, pull it apart.
Yeah, not to have it. So first is what you said. When are we taking depreciation? Let's talk about depreciation first before talking about making 200 on your job. So people saying is, well, your biggest tax benefit, you are taking depreciation, yada yada yada. Let's be clear about that, what depreciation is. Depreciation only applies to rental properties. Like we have like daily questions from people and they talk about is, okay, I'm a new wholesaler, you know, how do I do depreciation and erase all of my taxes? Dude, you have no depreciation. You're a wholesaler. Okay,
yeah, so, no, I already knew that. I already knew that.
But sorry, not talking for you, like talking for everybody who is listening to us right now. So let's be very clear. Depreciation comes into play when you have rental properties only. So if you have, and if you have rental properties, so not when you are wholesaling, not when you are flipping, not when you're owner financing, when you are holding rentals. And when you are holding rentals, this is how it works. You got $1,000 a month rent, and your carrying costs with all of the expenses is 800. So you have the 200 cash flow. And people are saying, okay, am I taxed on 200? The answer is no. Because for tax purposes, first, you don't have 800 of expenses. And two, there is depreciation. So let's quickly make sure there is no confusion about that. Why I said 800 is not the right number for taxes. Because when you're looking at cash flow as an investor, you're counting mortgage payment in your 800. You're looking at cash flow, you're saying, I have 1,000 rent and my costs are 800, including mortgage payment. Okay, you don't deduct mortgage payment for taxes. What you deduct is interest portion of the mortgage payment. So it will not be 800. It will be 650 or whatever, like principal portion of mortgage payment does not count. So that's kind of the bad part. The other bad part is what you call repairs may or may not be immediately deductible. So as an investor, everything you put in is, okay, I put $5,000 new roof in. I put 5,000, I want to deduct it. You cannot deduct 5,000 new roof as an expense when you are doing taxes. You have to take that roof and it slowly deduct it over almost 30 years, like 27 and a half. So on the good part is, in addition to all of that, you get to deduct depreciation. This is briefly how it works. So you have house for 100, you take 20,000 of that is land, let's assume. So you have 80,000 house, and at 80,000 you divide over 30 years. You get about $3,000 a year deduction. That's called depreciation. What a deduction is you slowly deduct your cost of buying the house. Whether you have mortgage on that or not, you are deducting. You have 3,000 a year extra depreciation deduction. So when you count that in and do the balance, here is what happens. You might have 200 a month cash flow from that property, but when you add depreciation in your calculation, you are negative. It looks like you are losing money. So for Uncle Sam here, you are telling it, dude, I'm losing money. In reality, you are making 200 a month. So that's sweet. And people get carried away with that saying is, oh, great, I'm deducting depreciation, that's a freebie. First, that's not a freebie. Okay, that's a different conversation, but that freebie comes back when you are selling the house. When you are selling the house, you have to return the depreciation benefit, unless you do some like more advanced strategies, like if you are doing 1031 exchanges, if you are doing opportunities on funds, like stuff like that. So you have some ways to deal with that. but depreciation will eventually come back to you. It's not a freebie, it's a loan. Okay, but during those years, you have that you deduct depreciation. And when it becomes negative, here is what we have. We take a normal single family home, and that home can have a $5,000 negative every year. So now you have a job. So you have normal W-2 job and you are making 70 grand a year salary. So you have 70 grand year salary. You have house on the side on which you lose 5,000, including depreciation. So yeah, exactly. Yeah.
Lose.
Exactly. And so 70 minus 5, you know, pull your calculator out, it's 65. So right, you're paying taxes on 65. Great. What if I have two houses? So now I have two houses. I have 10,000 loss. Now I'm paying taxes only on 60. Three houses on 55. And you start going, okay, let me do my math. So I need to erase 70,000. If I'm losing 5,000 per house, 35 houses, and I'm like clear, zero. That's not how it works. That's
what I was going for in life.
Yes. The idea is correct, but then there are some breaks. Okay, that IRS code that you called clear earlier. So that code says it. You can go up to 25. So you can reduce, if you have 70,000 salary, this way, and you're having losses from your rentals, you can drop it by 25 grand tops. 25 it stops.
But if I'm in a higher income bracket, I don't even get the 25, correct?
Oh, yes. So right now it's at 70. So you have 25. So you can drop your income down to 45 maximum. After that is what happens. But I have no losses. Yeah, I had 50 losses. You're only letting me take 25. What happens with the other 25? The other 25 you push forward. It's going into the future. It's not going here. Like, that's important thing to understand. It's not going here. Not in the waste basket. You're not wasting that. You're not throwing it away.
Okay.
But you cannot use it today. You are pushing it into the future. When can you use it? Next year, the year after, whenever, or when you sell the property. When you sell the property, everything opens. So if you had that extra reserve that you could not use in the past because you reached that 25 grand limit, then when you sell, you can take all of those losses. But you have to sell the property to do that.
So you could so let's say you made 100,000 and you had 35,000 in reserve, but you made 100 on the deal. Now that's down to 65,000 that you made.
Correct.
When you yeah. So you pay, and then you would pay long-term capital gains on the 65, correct?
Yes.
That's good.
Well, I said yes. Technically, it's more complicated than that.
Yeah.
But
well,
the way to present it, yes.
In a perfect world, if everything was
such. It actually is slightly better than what you described, because what happens is you would pay 100 grand capital gain, but you deduct 35 at ordinary rate. You benefit on the rate difference. So it's actually better than what you said. But I don't want to dive like too deep into
No, because I mean, look, there's a lot of people that are going to watch this that aren't going to have a clue about the language. They just need to understand. It's like when I'm on a deal with Spoon, I'm like, hey, Spoon, they don't care about what's going on with the APIs and all of this. They just want to know, when I send a text, is it going to have the address in there? You know what I mean? Like, will this code this address in for me so I don't have to type the address in every text message I'm going to send? So I've written some stuff on the board because this is stuff we're encountering in our own business. Okay. We sit down with other investors all the time. Right now.
Correct. Before we go there, can we finish about the 200 thing?
Yes. No, go ahead. Finish.
Sorry to interrupt, but let's, while we were on that topic. So you correctly said, but as your income goes higher, my example was 70 grand.
Right.
So at 70 grand, you can slice off 25 grand. But as you go higher, you start losing the 25. Once your income takes 100, you start losing 25. And when it's at 150, you lose the entire 25. You get to zero. And that's, by the way, for married people combined. So it's you and your wife combined So if you crossed 150, you have zero room to deduct losses from rentals. Zero. All of them are, again, you don't lose them. All of them are pushed into the future. You can take them when you sell the property. Okay. But today you cannot. Even we have a lot of doctors, call us. I'm saying is, okay, I'm making $250,000 or $500,000 a year. So I want to buy rentals to stop paying taxes on my $500,000 salary. You cannot do that, doc. Sorry. Cannot do that. And the way around it, and that's where the guy who you are quoting could have been correct. It depends on the context.
Ooh.
Okay. Could have been. That's what we're talking about. It. How do you make your $500,000? That's the key. How do you make? Because in my example, we're talking about you having a W-2 job. You're having a W-2 job, goodbye. Game over, you lost. You cannot do anything. Getting W-2 income, like people saying is, yeah, I hate JOB. Fine, but one more reason to hate JOB is you cannot remove taxes from W-2 income. Like you can do a little bit of tax planning here and there to reduce it a little bit, but not by much. Okay. So if you're making $500,000 on W-2 job, you're going to pay taxes through your nose. There is not much. Even the smartest guy, like the best CPA in the world, cannot remove that. When you read those books, and they're saying how to pay zero taxes. Those webinars like zero tax wealth and all of that. Yes, but they're not talking about W-2 people. They're talking about
contractors.
Yeah. What? Sorry.
So if I'm a contractor, if I make my income on 1099, like when I was in the oil field, I was a consultant, so I was paid as a contractor. So I would make $300,000 as a contractor, but I'm obviously not in real estate. But could I take those deductions against my contractor income? Because if so, I've got some consultant friends I'm going to reach out to after this podcast.
In that specific example on oil field, no, cannot do that. But what you can do is this: if you're making this 300 in wholesaling, then you can. Then it's a different game. So if you are a wholesaler, if you are a realtor, if you are a flipper, if that's where your $500,000 comes from, then you can take all of the rental losses against it. And yeah, go ahead.
Let me because I see this. I see all these large big box wholesalers out there, flippers that are making stacks of cash according to their Facebook feed.
According to their Facebook feed.
I mean, I don't know. Like I haven't seen a tax return yet.
Then they come to me and they are broke.
Well, life happens. So we can take all that money and I want to shove it into Cardone Capital, right? Grant Cardone's hedge fund. Okay. This is an off the wall thing that I was thinking about. I was just thinking about this when I was in Phoenix. Can I invest that into Cardone Capital if I'm a wholesaler? If I take every dime I make and invest it in Cardone Capital and lower my tax burden because I'm going to get depreciation and all the benefits from being in that fund like that. So essentially, if I'm a wholesaler and I don't want to own rentals, I don't necessarily want to manage them, but I want to capture the tax benefits, could I invest into a fund that is doing holding rentals and get some of that? Because I see Cardone pitch it all the time. I see all these hedge fund guys pitch it all the time. If you're in a wholesaler, it seems like the perfect crime because you're already in the same industry. Does it work that way, or is that something you'll have to look into?
Yeah, here is the problem. This guy is still the problem right here. Now, Cardone can do it because he runs that fund.
Right.
You can't because all you did is you just invested money and you are not participating hands-on in that operation.
So when you invest in that fund, you don't get to get any of the depreciation benefits because that's what they are pitching every time I hear them throw that pitch. Because he specifically on one interview talked about a woman that put $4 million into his fund and got all the benefits of depreciation with the $4 million that she put into the fund on the income that she earned from the fund.
You put me in a tough spot.
I got you in a tough spot. Well,
No, you put me in a tough spot because you love Grant Cardone.
I don't know. No. Grant Cardone's the only one I know that has a fund that I listen to. you know,
No, I watched your webinar with him. It's okay. So I know you have, like, you love his books, you love his approach. And okay, when the guy talks about real estate, okay, I assume he knows what he's talking about.
Right.
But when he talks about taxes, that boils my blood. And here is what boils my blood. The guy freaking have degree in accounting. Grant Cardone has degree in accounting.
Right.
He gives the shittiest tax advice on earth when he talks about that online. That is absolutely ridiculous. How, like, when I hear wholesaler giving tax advice on Facebook and things, yeah, that's normal. I mean, the guy does not know what he is talking about. Grant should know. He should know what he's talking about. He was selling cars after that. He never used his degree, but he graduated with degree in accounting. And no, that doesn't work like that. Okay. When you are a passive K1 investor, okay, those losses cannot go into that bucket that we are talking about. It can erase your profit. This is what happens is, first, we are talking about depreciation. You don't take depreciation when you're in a fund. The fund takes depreciation.
Ah.
So what happens is yes, whatever they do, whatever their big fund accountant did, so they own properties, they have deductions. So they did that, and then they chop it into small pieces. Mm-hmm. So you get your like 0.3% of the whole pie on a K1, and that K1 may have a negative number. What my saying is, yeah, as an investor in that fund or that partnership or whatnot, you got 30,000 loss that year. But that 30,000 loss goes into that same bucket we were talking about.
Right.
You cannot even use 25 on that, because to use 25, what you would have to do is you would have to own at least 10% of that fund. You don't own 10% of that. So that whole 25 goes out.
Okay.
On the smaller ones, here is what happens with that loss. That loss sits on your books. Then when they sell that big apartment complex and give you K1, where you have portion of the capital gain of the huge property sold, and suddenly you're looking at, oh, here is my $500,000 gain. Okay, against that $500,000, you would be able to take all of those old K1 losses.
I got you.
But you cannot have your high-paying W2 job and be deducting those losses from K1, from many passive investments like syndications that people love so much. That's a great thing, but syndications are not tax shelters. Like, that blows my mind when people saying is like, yeah, I will invest in syndications, cut my taxes. Syndications are supposed to make you money. 3 years later down the road, they sell the complex. You get that huge capital gain. You make money.
Right.
And when you do that, by the way, is people saying is, if you invested in syndication, they sold the property, you cannot 1031 that.
And that's why Cardone was so interested in the exit. That's why he shit all over us. He's like, oh, you can't exit that. And I was like, well, why do I want to exit it? I want to hand it to my daughter. I don't want to exit. Mm-hmm. My exit is death. Like, I'm out. So that's man, I feel like we could go for 8 hours, but
absolutely. We sure can. Okay. So now what you had on your board? Yes.
I wrote these up here because we sit down and talk with a lot of investors, right? So we always talking, and you want to know what other people are doing. You're like, hey, what are you doing? What are you doing about this? What are you doing about this? Every year at this time of year, and we've systemized it now to where you don't get paid unless we got your Social Security and all your information. I don't even know what that form's called, but that W-9 or whatever it is. So we can send you a 1099 at the end of the year. You're not going to get paid until we have that. And so we're collecting that information. But when we're sending out 1099s, I mean, we're last year we had 1.8 million in revenue. We paid out some very serious cash to contractors flipping houses and everything you could think of in apartments. So you can mess up on a 1099. Like, it's not that hard to make a mistake, right? It's, I mean, we're all human. We're talking with other investors and they're like, yeah, we don't send out 1099s. We don't send them out at all because we don't want to take on the liability of making a mistake on one. And we're like, okay, I don't know if that's right or wrong. You know what I mean? But we're sending ours out. And then, you know, you learn through progress. So we've got private money lenders. We've got friends and family that loan us money on real estate. And the way that the note's structured, we pay them every month. But whenever it sells, that interest gets paid. Part of that interest gets paid from the title company. You know what I mean? Part of it doesn't come out of our bank account. It comes from the title company. So they come to us and are like, hey, I'm trying to claim this income, but your 1099 doesn't match what I actually made. And we're like, well, because part of it came from the title company. Okay. Now we've convoluted a lot of things like I like to do here, but are you better off not sending out 1099s and, not having that liability of making a mistake on there? Or every CPA says you have to send them out, but every investor I meet with is like, I don't want the liability of making a mistake. I would rather pay the $225 or $75 or whatever it is to the IRS for not sending them. So what's your opinion on that? Risk reward wise, what would you say?
First, I don't even understand the statement about being like responsible for what you lose me with that.
Okay.
What kind of responsibility you have for making a mistake on 1099?
Jacob.
I have no idea what you're talking about.
No, well, this is a Jacob question. I don't know what the penalty for making a mistake on the 1099 is. I don't have any idea. I don't know if the liability falls on us.
I don't know what it means, like mistake on 1099, and why would you worry about that? So let's again split two things. There are 1099s to contractors, and then you brought issue of private lenders. That's completely different.
Well, it's a 1099 INT.
Right. Okay. Let's talk about, before talking about interest, let's talk about contractors first.
Okay.
So on contractors, the rule is pretty clear. If somebody provided you 600 worth of labor for the year, you should send 1099 to the guy.
Right.
Which means before he starts work, you need to get his social and address from him. And that applies not just to guys. The easiest, by the way, thing about that is when we finish, I will send you a link to my article that gives all the rules on 1099s.
Okay.
You can put it under the video in comments.
Okay.
And read my blog post about the rules on 1099. I'll mention like couple of them here quickly. And so first is, okay, you send it to every guy or every company, not just a guy, to companies as well, with the exception of corporations. You don't deal with corporations. People saying, oh, he has an LLC, I don't need to send 1099. LLC is not a corporation. You do send 1099s to LLCs. You do. LLC is just as liable for 1099 as anybody else. Only a corporation. So how you go about that is you give everybody the W-9 form, like it's like half-page form, essentially, when person has to say, I'm Michael Plaks, my company name is REI Tax Firm. So I put there EIN for that company is, and I put my EIN, okay, which is, if I did not have a company, it would be my personal social. And then I have check boxes. How do I run business as? So I can check LLC, partnership, corporation, whatever. If I checked corporation, you're off the hook. I checked corporation, Uncle Sam cannot come to you, and I'm saying is, why didn't you send 1099 to Plaks? You're saying is, Plaks check the box, he's a corporation. Okay, so you're good with that. The best way to avoid all of that issue, however, is not pay cash and checks. Pay electronically. So if you pay electronically, you don't need 1099s at all. If you pay PayPal, or any kind of electronic processor, it's not your problem anymore.
Okay. And that's what we found out last year, because I paid a lot of people through PayPal.
That's the best way. The best way to do things. Then you don't need their socials. You don't need that stuff. It's not your responsibility anymore for 1099s.
Now, let me ask you this.
The PayPal. Yeah.
So AppFolio, you might be familiar with AppFolio.
Yes, of course. Mm-hmm.
We pay electronically with AppFolio. Does it fall underneath?
It does.
AppFolio.
It does. It does. You use that portfolio as electronic processor of your payment. You don't have to do 1099 in this case.
That's amazing.
Pay electronically.
Jacob, you hearing all this? Jacob's going to listen to it later. He's sitting over there doing 1099s right now. So,
okay,
poor guy.
In fact, it's even bad. You are doing people disservice if you send them 1099 on electronic payments. This is what would happen. And here is an example. I'll use my firm as an example. We bill everybody electronically. So people pay us through PayPal or, through another processor, depending on 2 different systems we use. Right. So if you also send me 1099, this is what happens. PayPal sends me a form that says, last year, you charged everybody $1 million or whatever, through PayPal. And then if everybody sends me 1099s for the same amount, then it looks like I made 2 million instead of 1. The Uncle Sam will have double reports on me. Right. So do not send 1099s if you paid people electronically. If you pay checks or cash, then 1099 kicks in. Okay. So the other thing was with a lender, okay? With a private lender. Private lender is, okay, different situation. Let's talk about, there are 2 different forms. There is 1098 and there is 1099 INT.
Right.
Okay. So 1098 is, when you receive 1098, it shows how much interest you paid. When you receive 1099 INT, that says how much interest you received. So that's a key difference. So when you have a lender received money from you. So you send them 1099 INT, and if you send them that private lender 10 grand on 1099 INT, he will have to claim interest, that 10 grand as taxable income on his return. So that's why they become, picky about that. They want that information to match.
Okay.
Which is the opposite. Okay, now if you are a lender and they borrowed money from them, then they want to deduct the interest they paid you. Then you send them 1098, different forms.
Correct.
Okay. And one thing people get wrong a lot of time, them saying is, if I don't have 1098, I cannot deduct the interest I paid. Yes, you can. You don't need 1098 form to deduct your interest. Let's be clear about that. Okay.
Okay. So the difference in that is, or at least for us, part of the interest gets paid out of closing from the title company.
Mm-hmm.
So the money that we pay to all the lenders doesn't always end up in our bank, doesn't flow through our bank account to get to them. So we're 1099 INT-ing them for only the amount we pay them, not the amount that the title company pays them. And so there's a discrepancy in, for them, you know what I mean? It's like, hey.
They don't need to complain. Okay. There are 2 ways to deal with that. One is you can put on 1099 INT the full amount. You can include what they received at closing from title. You can, because the title company is not reporting that to them.
Right.
If they want real match, sure, you can put it on your 1099 INT. It's not wrong.
Okay.
On their side, it does not matter. They should not complain, because if they receive the 1099 from you that says 5 grand, but they really received 7, all they have to do is claim 7. The IRS is not going, like Uncle Sam is not going to call him and saying, wait a second, I only have 1099 that says 5 grand. Why are you reporting 7? They don't complain about that. They complain if they have 1099 for 7, but the guy only reported 5.
Right.
Then he wants to talk to you.
Right.
But in these cases, if they know how much interest they receive, they don't need 1099 from you. They can just claim it. So you sending them 1099, you are helping them, but you don't have to.
Okay.
Well,
we just
you're responsible for by the rules. You do have to send it.
Right.
But they can live without it.
Okay.
They don't have to have your 1099, and it doesn't have to be accurate. They have the right to complain if you reported more interest than they actually received. Then they have the right to complain.
Okay. Well, so back to the 1099s. You said pay everybody electronically, okay, to avoid it. What about my friends that are paying people with checks and cash and just not doing the 1099s? What's going to happen to them?
The honest answer is most likely nothing is going to happen.
Okay.
If we talk about practical, because here is the question you are asking. You are saying is, I always drive 80 on the highway.
Right.
Okay, what is going to happen to me? Well, depending when you drive. If you are not in one of the speed traps things, is you can drive 80 all your life in Texas and never have a ticket.
Right.
Well, I'm in Houston. Inside Houston, there is a little town called Bel Air. Okay, and in Bel Air, where speed limit is 35 and you are driving 37, Bel Air cop can give you a ticket. They're notorious for that in Bel Air. So it depends, okay, where you drive. So the IRS does not catch not filing 1099s in most situations, but it does happen, especially with construction. Like if you're a builder or high volume flipper, they will catch up with you.
Okay. What happens when they catch up?
Yeah, go ahead.
What happens when they catch up?
What happens when they catch up? This is what is happening. They are looking there at your tax return and you claim 200 in labor as a deduction. So the question is, who did you pay 200 grand to?
Right.
And one stupid answer that people saying is, oh, that's what I will tell them. The threshold is 600, right, per person.
Right.
So I just had 500 people, and and each one I paid less than $600, so I'm off the hook. I mean, nice story, bro, but it doesn't fly.
Okay.
So you cannot say that. So what happens is this: they look through the list and saying is, okay, who did you pay your labor to? Let's look through a bank statements. Let's look at your checks. Let's look at everything. And if it turns out that you never sent 1099, then you first time have this humongous penalty, like a few hundred per 1099. I don't know. Like people who are saying is, yeah, I'm willing to pay the IRS. Why? Why do you want to volunteer 500 penalty per contractor when all you have to do is report his social? Now, here's what people saying is, yeah, these guys are illegals. They don't have socials. Okay. Here is the thing. What happens in this case, it's a catch-22. You have a conflict between two federal laws. One federal law says, that's that IRS law, the tax law. The tax law says, if you have legitimate business expense, you can deduct it. Okay, day labor is a legitimate business expense. You picked guy to Home Depot parking lot, he did real work for you, you can show you paid him check, that's a legitimate business expense. But there is another federal law, which is labor law, and says you cannot hire a guy who does not have the right to work here. So which law prevails? You cannot break that situation. Let's talk reality. This is what IRS can do. That what realistically they can do is they can throw away your labor deduction. So if you cannot show with your 1099s where it went to, what they can do, that's the worst, basically, the worst situation they can realistically do. They say, okay, we remove the 200 labor deduction that you took on your return. So now you have to pay taxes on that labor. Now that's very unfair. That does not really happen that much, except like in the biggest cases. And those cases that we have seen, those are construction companies. So construction companies, builders, they do deal with that situation. So first year, you usually get a slap on the wrist.
Okay.
From second year, like first year, they tell you, okay, don't do it again. But second year, you better have 1099s or hire people through an agency. Like you really want day laborers, okay, there are those community centers that give you day labor. Yes, it costs you $2 more, but you don't have to worry about insurance and you don't have to worry about 1099s because you pay the agency. So you want to avoid that problem as a builder, get people through a third party. Don't hire guys directly. Or if you hire, get the clean ones. or be prepared to pay taxes on their labor.
Okay.
If it comes to that. Small guys don't deal with that. And there is a debate on, I have to mention that, as there is a debate very frequently online. I participated in a few, but then it gets old and boring. Like, I mean, I said it 50 times. I don't want 51st debate about whether landlords have to do 1099. So here is what people, where people are correct. If you are a casual investor, if you have 3 houses on the side, and all you have is just like you own 3 houses. Yeah, when you are passive landlord with a little bit of sides, a little bit of portfolio on the side, yes, you don't have to send 1099s. That is true. But I think that a little bit more complicated with the tax reform. The tax reform gives you the 20% deduction on your net income. To claim that deduction, you have to qualify again, quote unquote, as trade or business. If you're a trade or business, you have to send 1099s. Very clear. So if you are going for that new deduction.
You just said very clear.
Oh, damn, I said so. Got me. Yes, yes. In this particular provision, it is clear.
Okay.
If you want the benefits of the new 20% deduction, you have to send 1099s, even if you are just a landlord. Okay. Or if as a landlord, if you have a business, you know, you have LLC that files partnership return, it does need to send 1099s. Very clear. Even if all that partnership does is holding rentals, need 1099s. That exception is for people, again, who have a few rentals on the side, claim that on personal return, not on a business return, and don't need the 20% deduction. Yes, those can skip 1099s.
Okay. Since we love online, we met online. I see people talking about the 179 all the time, the 179 deduction, and I don't know that questionable write-offs are, you know, I mean, like what you said, you can drive 80 until you can't. You know what I mean? So these 179 deductions, I see people taking, you know, trying to write off a wakeboarding boat or a a side-by-side or just ridiculous stuff that people want to write off as a business expense that might not necessarily be a business expense. I'll give you an example. I buy an Airbnb on a lake. Okay. So I have an Airbnb. It has a pier, and on that pier, it has a place for a boat. Okay. So I buy a boat and stick it in there. And now I'm like, it's part of my business, because I could give people access to the boat if they so chose to pay the fee that I'm charging, but the fee is $5,000 to rent the boat. So nobody ever rents the boat, but it sits at my Airbnb. So I took it all on a 179 deduction. What do you think about stuff like that when you see it? Like, you know what I mean? Like, what do you really, what's your real beliefs on it? Because obviously I'm going to be out there. Me and Emery are going to be on the boat. We're going to be having a great time. And that's about it. You know what I mean? Like, nobody's really going to use it for the business. So what, you know, I see real estate investors say this all the time. And it drives me nuts. Like, well, I could have looked at some real estate while I was on the boat. Yeah, you could have, you know what I mean? But what are you actually going to say when they knock on your door? So what are your beliefs on that? Whenever somebody brings you some crazy write-off like that, what do you tell them?
I tell them to use Michael Plaks mirror test.
Okay.
And here is how it originated. Years ago, when I was working out of my home office, I had a full-length mirror on the closet door. And when people started telling me that story, I bought a boat, and that boat is for business, and it's only used for business, so I'm going to deduct it. This is what I told them. See that mirror? Okay. Tell that story in that mirror, looking at yourself in the mirror 3 times without cracking a smile. If you can do that, if you can keep a straight face, telling that the boat is strictly for business, I'll dance with you. Okay. But nobody can keep a straight face. They're saying it's like, yeah, it's for business, but yeah, it's for me, business between me and my body. Okay. And we happen to invest together, so every time we fish, we talk business. Okay, cannot keep straight face saying that. Can you deduct both if it's legitimately for business? Well, let's talk about hypothetical situation. Is okay. So you have that boat and you are Cardone. So what you do is you invite people to your lake house and you put them on a boat and you take them on the lake and you let them have fun and all that good stuff. And while they're on the water, you give them your spiel for an hour, like talking about your fund, talking about your deals, and getting these people to invest. Now, 2 months later, we show the list of your investors in your fund, and 5 people from that boat gave you 100 grand each.
Yes.
We have a good case. Good case where if he audits you, he sends you the IRS audit note. Everybody is brave. Like I love those people. Look, we are in Texas and everybody says, that shit would have never happened to me. I carry, I mean, like, dude, like, I believe guys who served and saying is, okay, that guy probably, if he is jumped, he will probably pull his gun and shoot the guy. But if you have never served, never were in a fight, and you're telling me I will, let him come to my house. He will come to your house, he will shit in your pants. Sorry. Dude, like, don't give me that, So what I'm saying is everybody is brave until they have IRS audit letter. Then they have that IRS audit letter, and those brave Facebook, IRS experts come to us, their hands are shaking, is, Michael, what do I do? They're auditing. So if they audit you and you have that boat case we just described, I will take that case. I will go to him and I will tell you, Corey, I have like good chance of winning that case.
Well,
I just described to you what I'm doing. I'm regularly putting group of people on that boat, end up recruiting them to be my lenders or like investors in my fund, and then I can show that those people after that actually invested. Good case.
Okay.
Bad case is trying to saying is like, yeah, all of last year, I had like me and my buddy, twice a month fishing there, and we do business together. You did business with him before the boat. Boat had absolutely nothing to do with that. But we talk business there. Didn't need a boat for that. You could talk business. Yeah, you could talk business, in a beer place next door.
Well, yeah, I see that, and I see people talk about it. And then the other thing I see people doing is wrapping their sports car with an ad, and then somehow I don't even know if that's I don't know what their angle is on that one. Like I really don't know. I guess you could definitely write the wrap off. I don't think you could write anything off on the sports car. Maybe the mileage. I don't know.
You can write the wrap off. The danger there, by the way, it's not my zone. I'm not an insurer. Right. But when you do that, you probably violate your car insurance. So be careful. Be careful with that. Because if you get in an accident and you have that wrap on your car, your claim can be denied. I've heard stories about that. Because right now you were driving business vehicle, you didn't have a business rider on your policy, so they may refuse to cover you. Be careful with that stuff. At least talk to your agent if you do that. But tax-wise, here is what they're claiming, trying to do. They're saying is, if I have my Camaro, so I wrap that, so my Camaro right now is business vehicle, I'm going to deduct the full cost of the car. Cannot do that.
I didn't think so, but I don't know if they're doing it so they can write off the mileage, but I don't know who would be wanting to rack up miles on their Camaro anyways. You know what I mean? It's like, well, you're gonna take your car and just depreciate it further by, I don't really know. Like, it's like, so now I can take my wife to the mall and write that mileage off.
It's much simpler. All you need to do is just, jump on the hood, borrow a Lambo, jump on the hood, make a picture, and now you are a guru and can charge for your program. So that's that's how we use the cars for taxes. Well, but realistically, it's this. You mentioned 179 before. This is where 179 comes in. You buy a full-size truck, and you use that truck to haul your materials. That's what the truck is for. You can write the whole cost of the truck through that 179 deduction.
Right.
That's the correct use for that.
But
Yeah.
I can own that truck in my personal name, correct?
It really does not matter if you use it for business.
Okay. Okay. Because
Mhm.
our little DJ, you know, our little high school kid, he uses this truck all the time for business. He's obviously 1099. He works for multiple people. He goes out to other investors and stuff like that. We 1099 him because we don't want him as a liability as an employee. We don't want to take on. We don't want to adopt the kid. We want him to be able to go out and do mowing for other people, and it not be our liability when he's on the road mowing for somebody else. You get what I'm saying? Like we don't want that, because some days in our business he's doing work for Shane's and getting money from Shane. Some days he's getting money from us. Some days he's getting money from Brennan, and we don't want to convolute that because it just makes it real complicated for him. But I told him, I was like, you bought that truck, you need to get in front of a CPA, because I'm not certain it's a used truck. I don't know the laws, but you need to go talk to your CPA and find out if you can deduct that truck, and that'll wipe out all your income for last year. And he's like,
he probably can. You just need to tell him the full story and be careful about that.
Well,
if he's able to write off his entire truck, and then he ends up selling it or trading it in for $5,000, that $5,000 becomes taxable income to him.
Okay. Well, and that's what I told him. I said, you need to get in front of a CPA, because you've got all these 1099s from everybody coming at you this year. He's right out of high school. He don't know nothing. I'm like, you need to figure out what this tax situation is going to be, because I know you and you're broke, and so you didn't put up anything to pay. So that's probably going to come back on us to have to help you make some money so you can pay Uncle Sam. But I don't think you're going to owe much, because last year he didn't have to pay anything because his parents, and he didn't make enough. You know what I mean? But we want to get him off right, because hopefully within this year, within 2020, he's already becomes a landlord. That's what I hope for him anyways.
Can we talk about the kid just quickly about something else?
Yes.
You just said that you want to set him right. Doing 1099 is the opposite of setting him right, unfortunately.
Why is that?
I'll jump on my soapbox for a minute here.
Okay.
And people disagree with me on that. So, but I'll tell you what I think about that. Starting to pay a kid on 1099 is setting up for a huge trouble with the IRS. This is why. Well, I have kids myself. That's my youngest is 18. So and two older kids. So like I know a little bit about kids getting paid on 1099s. When kids get paid on 1099s, the entire check is their money to spend. And that happens with adults too. Like, doesn't have to be a kid. Adults are big kids. That's the only difference. Every 1099 check you receive, that goes to pay bills, that goes to have fun, that goes to people.
Come here.
So what happens then is, at the end of the year, you realize that you owe IRS money. And people saying is, wait a second, at the end of the year, everybody gets a refund. What the hell happened? You get a refund when you have a W-2 and they take taxes out of your paycheck. When you get 1099 and no taxes were taken from your paycheck, you are going to owe the IRS. And then what happens at that point is this kid comes there and saying is, dude, you screwed me over. What did you do to me? I just went to my tax guy and he says I have to write $5,000 check to the IRS. I don't have that money. What did you do to me? And saying is like, kid, we were talking, remember when I hired you, you're responsible for your own taxes. But you did not tell me, man, that I will have to write a check to the IRS. So you're responsible. So this is not setting up them right. These guys start getting behind on the IRS on their first year. So giving 1099s, that's the problem.
Well, this is why we're catching it right now on DJ's first year. So here's DJ. DJ, this is Michael Plaks, the CPA.
Hello.
You probably need to call him when he gets off of here and hire him to do your taxes.
I'm gonna do my own taxes.
He bought a truck this year used. Can he 179 it? Most likely, or no? Yes or no?
Most likely yes, but I would have to, we would need to have a 10-minute conversation for me to sign off.
Okay.
On that, but most likely yes.
Okay.
Because if you are doing wholesaling and contracting and those types of jobs, truck should be deductible most of the time.
Okay, there you go. And well, hey, you bought the trailer too.
Yep.
Same deal.
So
That's
you got
used
the
for nothing but work.
that's used for nothing but work. So you're good. We'll get you set up, DJ. Say hi to Michael and the good people on YouTube. You got any work orders to work on?
Refrigerator.
They're shouting yes from the other end of the office. And way to make it to work at bright and early at 9:30, sir.
I've been doing stuff.
Oh, bet you have. We'll see you later, DJ. But thanks for stopping by. So we
Or you had something else on the board that we needed to talk on, like I think.
well, I think on the 179 stuff I could go all day. Just because I see so much of it and it just blows my mind. But I also see people, and we could probably break these up into segments. We could probably just talk about owner finance 179. I mean,
Sure.
like people are idiots on Facebook, but some of the stuff I see about IRAs and trusts and tax free, I'm like, guys, I wouldn't even write that on the internet, much less say it out loud. You know what I mean? It's like what you're saying right now. It might be great. It might actually be real, but what you don't understand is there's a lot of people that you wield a lot of influence right now within your community, and you're leading people down a path of absolute destruction because, nobody, like if I wanted to do a 1031 exchange right now, you know what I mean, front to back, I would have to call a guy like you. I mean, I don't know if you do them or not, but that's the first step. When I see people in the Facebook comments talking about 1031 and flips, I'm like, what? What? Like,
Right. But that's the danger,
Do what?
That's the danger of having social media, because you have everybody sharing, and I'm saying, yeah, that's what I have done. That's what my dad did. That's what my brothers, cousins, sisters did. And that's how everybody should do stuff. It's the same, like everybody on the internet is health expert, everybody is an attorney, everybody is a tax expert, and people get pretty angry about that when you try to correct them, saying is, you cannot 1031 a flip. I know I can, my brother did it, my dad did it, and everybody did it. Cannot do that still, 1031s is for rentals, not for flips. Yes.
Well, I see that, and then I see, anyways. I mean, we just had a 1031 exchange within our family, and it was probably the most stressful thing I've ever seen people go through. You know what I mean?
Well, it depends. It's a good thing. It doesn't have to be stressful, whole situation. Like it's a very powerful thing if you apply it right.
Well, somebody came up and said, "Hey, I want to buy this." And they said, it's not for sale. And he said, just write down a number. And he wrote down a number, and they said, yeah, we'll buy it for that. Mm-hmm. And at that moment in time, it's more money than you ever thought you'd ever see in your entire life. You know what I mean? And now you're trying to get into a vehicle that you didn't know existed 2 weeks ago. And you got to identify and all that. And it made for a stressful situation for somebody that does it for a living and understands where they want to go with it and all that. It's not that stressful. But for a family that's just like, hey, this, I can do this. I want to do it, but obviously I don't want to do it right. I'm only going to do this once in my life, so I don't want to mess it up. You
have done it already?
Oh yeah, it's done. It's complete.
Okay.
I mean, it was just stressful because they had the 45 days to identify, and I kept trying to tell them, I was like, look, you can identify, but you can get off of that and on to something else. You got to close within 6 months. Like quit letting that 45-day deadline get you knotted up. Like if you get out there and some things change and you don't want to go into that anymore, then there are options, but
actually incorrect.
Is it incorrect? Because I get in and out of the 45 days all the time.
You have 6 months to close, but you can only close on the properties that have been identified within 45 days.
Correct, but you identify a group of them, and you don't have to necessarily go.
That is true.
Right.
Yeah, like you can find 3 properties and then saying is I'm going to close on one of them. But what happens a lot of times is people saying is, yeah, I'm interested in those 3. They put it on that 45-day identification document, and then they cannot close on any one of the 3. And then they're saying is, oh well, I'll close on this one, number 4. Cannot do
No, no. They had them all identified. They were just they were trying to scramble around all over the place to look at these and do their due diligence and all that within the 45 days. And I was like, guys, you don't have to have it picked. You've got them all identified. Now just go look at them. Do your due diligence. Don't worry about it. You got 6 months to close. So they but it worked out good. I mean, it worked out good for everybody involved. But those things that's the kind of stuff that stresses me out. Now, obviously, I had my questions lined up. Are there any messages that you would want to give to people? Where can people find you? Send me some links on Facebook, and I will pin them to the comment section of this video on YouTube. Your articles that you've wrote, any videos that you want to watch, I'll just stack them in there. What are some things that you would want to tell? Because I could go all day on 179. I do have this one question.
I can go all day too. Yeah.
The other day, obviously I went to Top Golf, and it was a ad lib moment where I was flying out of Houston and that storm held me up. And so I didn't get to do my event in El Paso, but we all met up at Top Golf. And of course I'm renting a Top Golf venue for 3 or 4 hours at $35 an hour, whatever it is. And I was thinking to myself, I was like, I just put that on the American Express. I'm not really certain that this is tax deductible. You know what I mean? Because entertainment has been wiped. You know what I mean? But we're in an event setting where we're just really renting the space. I don't know. It's a gray area for me, at least. You know what I mean? So on something like that, whenever you see those receipts come in, you know, entertainment's off the board. But if you're renting an event space like that, just to have the space and you're doing it for an event, like doing it like not for like a meetup, but you're actually like sitting down and doing stuff and showing people how to market, do different things. I mean, is that deductible not as entertainment, but as something else? I mean, that's a kind of on the spot question, and you'd have to look more into it, I'm sure.
No problem. There is no need to look at that. Okay. But again, there are a few different things that you put inside one question. Okay. One is, with the new tax reform, entertainment expenses out. Right. You can still have business meals. You cannot have business entertainment. So you can take a client or a business partner to dinner. You cannot take them to a game anymore and deduct it.
Correct.
Okay. That's the issue that happens. So if you're just taking somebody to Top Golf, you cannot deduct that because this is entertainment.
Got you.
If you are renting Top Golf for an event, that's a different situation. But that would only apply to people who are hosting events. That's the distinction. So let's be clear. You know, taking 2 of your buddies to Top Golf, no. Renting Top Golf for the company event, yes.
Okay. Well, and that's what, I was like, I'm fairly certain this is right. There's 20 of us here, and I got the Facebook pictures to prove it. So anyways, Mike, where can people find you? What is your specialty? Obviously, you're probably pretty busy this time of year. If people want to reach out to you for your service, where can they get in touch with you at?
Very easy to find. So my company is, I'm in business for over 20 years. And like those who joined us later, I'll remind you, I'm a black belt in real estate taxation. So, my company only works with investors. Okay. So there are very few people in the country in my business who can claim that we exclusively work with investors. So accordingly, my company is called REI, like real estate investment. REI tax firm. Okay. So you just type reitaxfirm.com and you got to my company. Very easy to find. Okay, and I'll give you links too, like so that's easy. So we help established investors with comprehensive tax planning, tax strategies, bookkeeping, tax preparation, of course, and stuff like that. Because really, that's the first time. Usually, during talks like that, I end up talking about bookkeeping a lot. This is the first time I use the word bookkeeping. But the problem that people have, like investors have, is not taxes. The problem is bookkeeping. Their books suck. Oh. And they're saying is, Michael, how can I save on taxes? And they talk about what entity can I form to save on taxes. And to me, it's like, dude, Your books are in a box. You know, half of your receipts saved in the box, the other half is at the bottom of your truck, and half of that flew out the window when you open that. That's your problem, not an S corporation.
Dude,
So bookkeeping is where it all starts.
I wish you would come to any of our events we have, any of the marketing events, anything that we do. The very first thing I tell people, because there's so
we can talk about that, sure, mate.
They never talk about bookkeeping.
It's not sexy to talk about bookkeeping.
No, it's not. But like whenever we started off on sub 200 finance wraps, I'm like, when you see the bookkeeping, just the journal entry it takes to make that transaction work, most of you are unqualified to do it. Jacob, my business partner, who's over there right now, balls deep in taxes, he writes it on the board and it confuses me. And I'm like, the average guy that goes into one of these seminars hears about how easy it is. I'm the average guy, right? So I'm the average guy. I hear about how easy it is. And it's an easy transaction to pull off. Allegedly. You buy one, you take over the payments. Pretty simple. I start making their mortgage payments. I put a little cash into it. Now I own the house. I have the deed. I sell it owner finance on a wrap, and money comes in. I make the payment. Money comes in. I make the payment. I got me a little $500, and I spend the $500 at CC's Pizza with my daughter. We're out at Chuck E. Cheese. We're banging frogs, and we do that for an entire year. Get to the end of the year, and now you got to account for it all. You get what I'm saying? Most people, that never even crossed their mind. They had so much fun at CC's. They done spent the money. They don't understand.
Have fun at CC's.
Wherever it was, whatever their vice is, they done. They enjoyed. They made the money. They did what the guru told them to do. They went out and pulled off the transaction. It worked. I'm making money. I got money. But at the end of the year, they don't have their any of their QuickBooks, and then they dive into it. They don't understand that they're collecting principal and interest. You know what I mean? They're paying principal and interest.
Correct. You're talking principal and interest. I'll talking you simple. Those things, when I got into that business early, those things blew my mind. Right now, I'm just like bored by that. But it's very, I said bored because it's actually very distressing. We got new clients. Most of our clients are bigger investors. And the rule is the bigger the investor is, the worse his books are. It's pretty much the rule.
Well,
here's what happens. Like, look, we have guys, and these guys did like millions worth of transactions. And we ask them a question, how much you made per deal? They have no idea.
None. And
like, how can you run a business if you have no idea how much you're making per deals? And then we did their books. We went through that. We're coming there and we're saying is like, I don't know, something is wrong. And the guy says like, what do you mean is wrong? Like I'm saying, my numbers show that you make less than 10 grand per deal. Yeah. Like after your marketing and everything else. And the guy starts denying, says, no way. We go through the numbers and after a lot of back and forth, he finally concedes, and I'm saying is, I guess you're right. So he makes good money, but he makes good money from volume. He does a lot of deals, making a lot of money on the volume. But each deal is such a thin deal. He doesn't even make 10 grand after he takes into consideration all his overhead, including like his employees and his marketing. What? And he's like, how can you run a business and you don't even know how much you make per deal?
That's one thing. I mean, that's a KPI that pulling a report on for us. I mean, it's all accounted for as it comes in, so it would be easy to figure out.
You track things, people don't.
Here's what happens to a lot of people, and this happened to us. This is a personal experience. We have Appfolio, so we have a trust account. We manage multiple properties with different partnerships through Appfolio. So we have a trust account. All the money comes into the trust account. All the bills are paid out of the trust account. What's left over is distributed. That trust account, I mean, you know about trust accounts. You know how they have to line up to the penny, because that's pre-tax money that hits that account. It's not accounted for. I see people talk about this all the time, and we did not keep the bookkeeping correct on our trust account when we first got it because we didn't understand We didn't understand how to run that account. So Jacob had to sit down and go redo every journal entry in Appfolio and QuickBooks for an entire year to get it right. Whenever we, went to the CPA and was like, "Hey," he's like, "What are you doing? You don't do it that way. Here's how you do it."
Tell Jacob I'm sorry.
No, it was look. It was
It's a
literally
pain. It's a pain,
months
yes.
of every day, and we hired somebody to help. But you don't know what you don't know, just like what you're saying. But when I see these people out here talking, I'm like, I tell everybody at every marketing deal, I'm like, guys, making money in this business, you will find, is easier than accounting for it. Staying lendable, staying and keeping your books right and all of that. If you don't have that person on your team and you're talking about scaling and hiring acquisition managers and all this, you need to be talking about hiring a bookkeeper. That's the first person on your team, because if you want to scale this to any level at all, you're going to have to be able to go to a bank and borrow money at some point. And if your books aren't right, you ain't getting no loans. You're not going to make it out. And that's where I'm blessed. I mean, I don't know if y'all can tell, I'm not a very good bookkeeper. You know what I mean? Like, it is what it is. You know what I mean? I don't get to pay for my own stuff anymore because of the receipt situation. I got an email that I email my receipts to, but I pay for very little these days. All of that is the most important part. And we didn't dive into bookkeeping not because it's boring or anything, but because what people need to understand about it is they need to call you and get that plan in place and get that person on their team and figure out what that's going to cost them, because that's going to be, I mean, the accounting on sub twos is probably my biggest sticky point, because I think we've had in all partnerships, we've probably got 30 wrap mortgages, and they're a pain in the ass every single month. Every single month they're a pain in the ass. Every single month putting in those journal entries is a pain in the ass. And it's not something that at the beginning that we were like, oh man, we really thought about, but it slows us down now because it's easier to do the accounting on rentals than it is to do it on the owner finance. So those just kind of slow us down. They pay, but they're slow. We keep that strategy in our portfolio because it makes money. We can make a note and sell a note, but now we build every note to sell, not build every note for cash flow purposes, if that makes any sense at all.
It does.
So that's something that we could come back into an entire segment on bookkeeping. I'll let Jacob take the deal then, because you and him could chop it up on a technical level than anybody else. What other things what really gets on your nerves when somebody calls you and they're like, something you see all the time that the average investor overlooks, other than bookkeeping?
I've been in this business for over 20 years. Not much gets on my nerves anymore. I'm used to that. I've heard all the stories. I'm more like shrug my shoulders, with the amount of BS that is done on Facebook, both about, like, I'm not even talking about taxes, about real estate, like real estate advice in general.
I'm one of those people.
It's ridiculous what people like teach other people to do. Like, people post on Facebook and I'm saying where can I get a proof of funds? Man, stop, just stop, and then what is more amazing is not that somebody asks where to get proof of funds, but that people actually respond to that and tell them. It's like, man. And the same on taxes, How do I 1031 my flips? How do I raise taxes on my wholesaling income? How do I do this? Okay. For people who are starting, who are new in the business, to me it's like, okay, stop worrying about that stuff. Stop worrying about advanced strategies. Stop worrying about LLCs. Stop worrying about everything complicated. Worry about making money. In flipping, more than 95% of first-time flippers lose money.
Right.
That's not like, I'm not a guru. I don't have to sign up anybody for my program on how to make million flipping houses. So I'll tell you the truth. When those people come to me, 95% of them lose money, not make money. And all of them worry about, what corporation did I need to set up to save on taxes? Dude, you're losing money already.
Yeah, you don't owe no taxes when you lose money.
Yes. taxes come on the, like, yes, like on that segment with Cardone is, yeah, he owns what, 8,000 units, he said.
Yes.
Yeah, you own 8,000 units, you need tax strategies.
Right.
You know, you own 1 unit, you don't need tax strategy. You need more units.
You need more units first, and then but you need to prepare yourself for the bookkeeping nightmare you could be creating for yourself if you don't do it at the front. Just like what you said with DJ earlier.
Mhm.
You know, get DJ started off on the right foot. As a new investor, if you're worried about scaling, don't worry about an acquisition manager. Find yourself a good bookkeeper, because that's what's going to allow you to scale in this business. Because most of us, like guys like me, if I had to do this on my own, I wouldn't be in this business at all. None. If I didn't have Jacob, this wouldn't even be an option. I would be back in the oil field, no doubt about it. So the Andrew asked an interesting question. You can't get a third-party servicer to handle the payments to and from sub-2 wraps, then it's all handled. Servicers are great for the 1098 forms that Michael mentioned earlier. I love servicers. That's the only thing we rely on them for, though, is that and chasing the payment. Making the underlying payment, if you leave it up to them, what they'll do is that they'll make the payment, but sometimes they'll make 2 payments. Sometimes they'll make 3 payments. You know what I mean? It's amazing what they'll do on your behalf, that they make mistakes too. And from a cash flow perspective, that it just messes up everything, because I mean, it just screws it up. So we took all that away from our servicers. We no longer allow them to make the payments, because they either made too many, or if somebody misses a payment, there's no money in that escrow account for them to pay out of. You know, they don't have any money to make it. So somebody's still got to make it. You're going to have to step in eventually on those. So that's a quick question answered. Michael, I'm trying to think of other things I want to ask. It always happens when I get off. I'll have like 700 questions.
You know where to find me, so no problem.
Well, but
we can do it again, Corey. So
I want to touch back on it, because we're every time I run across an issue, I'm going to write it down, and because I think we are on the same page when it comes to people talking, and I'm one of the people talking on the internet, giving bad advice, and I look back at my 2017, I gave a ton of bad advice, and you don't know what you don't know, and you know, it's like right now, one of the things that people talk about, or one of the objections we would have when we're selling a house, was the payment. You know what I mean? We're selling an owner finance. They would hate the payment. And back then, the mortgage tax deduction was a good selling point. But now that they've raised the standard deduction, you know, it doesn't even hit, the rubber don't meet the road there anymore. It's like, if you have a large standard deduction, you're probably not going to deduct this interest on your taxes, because it makes no sense to. So those are some things that you know, I see people still talking about, you know, oh man, tell them the tax benefits of owning a home versus renting. And I'm like,
yeah,
I mean,
you're right. Yeah.
They're not really there no more. So anything else you want to cover before we jump off?
No, because if you tempt me, I will start something that takes another 20 minutes. And we are like, what, hour and a half now? So.
Hour and a half. But I appreciate your time. Guys that just got on, go back to the beginning. Michael's going to send us some articles that he's wrote. I've put his website in the comments. I'll put it back up on the screen right here. That's where you can find him. Bookkeeping, taxes, audits. What all do you cover? Anything tax related?
Yes, of course, because like what we do is annual advisory service, which includes everything.
Okay.
You know, it includes everything. It includes bookkeeping. It includes tax planning, tax advice, annual letters you receive. If you are audited, we'll help you. So all of that is packaged together.
Cost segregation analysis. Do y'all do that as well?
We don't do the analysis as well. And the analysis itself, if you go out and do cost segregation from an engineering company, we will incorporate it into your taxes.
Okay.
And before you do that, we will give you advice on whether it makes sense to you. Like earlier, here is a good example. Earlier, we talked about how you cannot take those deductions when your income is high. Your income is high, you're already negative. And people want to do cost segregation. Cost segregation does nothing to you at this point. You're already negative, already maxed out, already locked cost segregation will not help you. So we will tell you before you spend money on that.
Right.
In other situation, it's excellent. But like everything you do, no strategy, no solution, no property, like is good for everybody. Like something that works for you will not work for somebody else. So,
well, a lot of people are just going to have to go Google what a cost segregation analysis is.
that is, yeah.
I mean, it's something that we researched a while back and came to the same conclusion that you just had. You know what I mean? We're not making enough money to worry about that right now. We'll do that in the future.
Just to be clear, no, I'm all for cost segregation. We just need to make sure that in your situation it helps.
Yes, yeah,
It helps
exactly.
everybody. But
Right.
when it helps a lot. Yes.
It does. I agree 100%. But for us, it wasn't the right time, which is why you need to ask somebody like Michael before you go jump onto that stuff. So, Michael,
Sounds good.
appreciate your time.
Thanks a lot for having me. It was fun, and we can do it one more time. So
You have a Facebook group too for anybody that wants tax advice.
I do. You mentioned John before. It's actually a joint group. John and mine, like called REI Tax and Legal Wizards. We specifically discuss all legal and tax issues of real estate.
It really is. I mean, it's a small group, but if you're tax questions, that'd be the only group I'd ask him.
Yeah, if somebody wants to join the group and I look and the guy belongs to 20 groups, none of them is real estate, we're not inviting that person. You have to be in real estate to be there. There are no promotions. You don't sell anything in that group. There are no deals. We're just talking about legal and taxation.
Right. And I love it. And I love it for that. All right, Michael, appreciate your time.
Okay. Thanks again, Corey. Okay. Have a good 2020 in your business, and we'll talk again.
All right. I appreciate it. Thank you.
Good luck to everybody, guys.
Yes, sir. Thank you.